Hey, it's Rav. Welcome to Everyday Investor, the hottest investment show in the world. That's right. I said it. I don't care who knows it. This show is designed to help us grow our money. You see, the challenge is we take our precious time, we go to work in order to make money so that we can eat, so that we can provide. We take our time, we go to work, nothing wrong with working, I think we're created to work, but we work a lot in order to get that paycheck so that we could provide. But imagine a world where money could make you money so you could have a little bit more time for the things that matter most to you in life, family, friends, a purpose greater than yourself. That is what this show is all about. Remember, when anyone offers you any type of investment opportunity, you always want to ask 4 questions to start. Number 1, what is the return on investment? 2, when do I get that return along with the money that I put in? 3, what is the minimum investment amount needed? And 4, look them right into their pretty eyes and ask them, what is the risk? What is the downside? We've got an incredible show lined up. We're going to be talking about, wait for it, we'll be right back. Coming up, Omar Khan teaches us how we can make money selling stock options.
I'd say the biggest mistake is picking poor quality stocks that they really don't care to own. But instead of saying, so when we make a trade here at Theta, we always make sure it's a high quality company because we make it so our worst case scenario is that we own a high quality company at a discount.
Hey, it's Rav. Welcome back to Everyday Investor. Super excited to be talking about how we can grow our money selling stock options. My good friend, veteran stock investor, Omar Khan is on the show. Omar, thanks for being here, man.
Thanks for having me, Rav. I appreciate being on your show and the opportunity to share what we have.
Listen, I didn't bring you on because you are a handsome Indian guy. I didn't bring you on because you're one of the few. I always say that, God made a few perfect heads in the world. The rest he covered with hair. That's not the reason why I brought you on. I brought you on because for the first time in, believe it or not, we are in our 17th year of doing a show like this. Here we are in the early stages of 2021. And I thought, Omar, can you teach us how to sell stock options? Most people, including yours truly, didn't even know what that was. You've been helping me in my account. And, if I told the viewers the returns, they wouldn't believe it. But let's just leave it at 2-3% plus a month. You're helping me trade in my account, and it's been about 6-7 months. So that's why I wanted you to come on to be able to teach this whole concept of stock options. Enough from my mouth. Omar, what is stock options as opposed to stocks, and how did you get involved in this?
Yeah, great question, Rav. So stock options are a pretty simple concept. So basically, a lot of people are familiar with the stock market, right? That's when you have a publicly traded company, let's say like an Apple. We use their products every day. Now, they trade on the stock market, so you can buy and sell shares of that company. That's a pretty simple concept. Now, options are derivative products on those stocks. Now, it sounds complicated, but it's not. What that simply means is this. In layman's terms, it's just like, for example, let's say Apple's trading at $130 approximately today, okay? And I say I got to buy a home in 6 months, okay? And I say to myself, you know what? Hey, I can't afford to get less than $120 a share for my Apple stock. Therefore, I'll buy some insurance on it. So it's a way to participate either buying stocks or selling stocks, but not committing all the money up front. So it's kind of like insurance. I'll explain more about what it is, but it's a unique concept. It takes a bit of explaining. Like, so for example, that concept I was talking about, let's say Apple's at 130 and I have to buy a house, and I say to myself, hey, I got to get at least $120 a share. Well, then I'll go and purchase insurance that says no matter what happens to the price of Apple, I'm going to get at least $120 a share because I need this money for a down payment on my house. So a lot of people use it for that. Now that's called hedging, but we'll get more into what it is a little bit later on. Yeah, absolutely.
So when it comes to stock options, there's the buying side and the selling side, and the terminology there's naked puts and there's puts and there's calls, basically when it comes to options. And so you you have told me, Rav, and we've been talking about this for, I don't know. I mean, I first saw you teaching this on stage in front of, maybe 1,500 people. You're sharing the stage with Grant Cardone, and you were talking about this concept. And, on the side, you would say to me, Rav, 95% of this or more could be risky if you don't know what you're doing. Omar likes to just sell stock options. You're not in the business of buying stock options. Talk to us, what does that mean? What does it mean to sell stock options?
So let's say, for example, we go back to that same Apple example. Now, Apple is trading at 130, okay? Now, if we're going to sell an option, so we're going to sell an option, let's say we're going to sell the 120 puts. What that means to us is what we're saying to ourselves is, hey, we're happy to own Apple at $120, okay? It's currently at 130. We love Apple at 130. We love it a lot more at 120. Now, simply for agreeing to buy Apple for $120, now remember, we would buy it for 130 anyways right now. We're happy to buy it for 130, okay? Because we've done our analysis. We like this company long term. We think the share price is going to go higher. That's what we know, and that's what we believe, okay? Now, I say to ourselves, why don't we agree to buy Apple for $120, okay? And simply for agreeing to buy Apple for $120, let's say the market pays us $4, okay? Just a hypothetical. Now, again, think of that. I'm more than happy to buy Apple for 130. I'm certainly happier to buy it for 120. And you're going to pay me $4 just for agreeing to buy Apple for a $10 discount? That is selling options. Now, the person who's paying that $4, that is a person who's buying that option. So, for example, we go back to that insurance example we talked about. That person who's going to say, you know what, I got to get at least $120 a share for my Apple stock, they're paying $4 a share, just they're insuring yourselves. We are essentially acting as a de facto insurance company. And the reason why it's good for us, underwriting-wise, okay, is because we're more than happy to own Apple to 120. And we got paid $4 on top of that? Great.
I'm getting paid a premium of $400 from Mr. Buyer, who says that he has the right or the obligation, I mean, not the obligation, but the right to buy this stock at $120 or less or whatever the case is, and then therefore I have to give it to him at $100. Today it's at $130. So Omar, is there a time in this contract? Do we put a time to it?
Yeah, absolutely we do. Generally speaking, we don't write puts or sell puts for more than a 45-day period. There's a very specific reason for that, and that's called Theta, right? It's the name of our company, okay? So what that means is the minute you sell an option, what happens, let's say I sell this option for $4. Well, immediately $4 a share, by the way. And if I do 100 shares, well, that's $400 US that I received in my account simply for agreeing to buy Apple for a $10 discount. And that's a good deal. But the minute we receive that $4, because essentially you're insuring this stock for a period of, let's say, 45 days. Every single day that option decreases in value. And since I'm the one who sold it, that is most beneficial to us, right? To me. Because the minute you sell that option for $4, it becomes worth a little bit less every day simply because of the passage of time. And in the next 45 days, if Apple doesn't go to $120, we keep the entire $4 and we can do it again next month and the month after that and so on and so forth.
Okay, so your goal, first of all, when you are doing this concept called this is called the naked put, and you're selling it. Okay, naked put. Yeah, naked put is not something that's triple X that we look on the internet for. This is naked means simply we don't own Apple. We don't have to own Apple. I can go to Mr. Buyer and say, look, Apple is trading at $130. If it goes to $120 or below, no, but Rav will buy it. Rav is obligated to buy Apple at $120. So it's at $130. Rav is obligated to buy it at $120 if it falls to $120.
Absolutely.
The reason why this guy wants that to happen is because if it actually falls to $115, he now has the right to buy it at 115 and I have to, and sell it to me for 120. And so he's making $5 per share. That's one reason that Mr. Buyer would do this, correct?
Yes. So if Apple's at 130 and again, you agree to buy it for 120 and it goes to 115, you still have to buy it for 120. So in essence, yes, that person who bought that option would make $5. But please keep in mind, they also paid $4 for this right. So their net profit would only be $1 a share. And that's if Apple happens to fall $15 the next 45 days.
That's right.
Odds of that happening are not usually very high, like on a longer term basis, like for a company like it could be. I'm not saying it can't be. There's certain stocks that are terrible. But if you've done your homework and you believe in a company, well, if you like Apple at 130, certainly you like it better at 120. Certainly you like it even more at 115. That's the concept. That's the idea.
Okay, so Omar, this is great stuff. And of course, for those of you that are watching, we never get into this without talking to an expert like an Omar or taking a course, or please, please, please do not jump into this. I still haven't personally jumped into this. Omar has been coaching me and helping me. So I just want to throw that out there. This is only purely for education purposes. Now, Omar, the person in one reason the buyer is doing this is because they are what's called bearish in the market. They're bearish on Apple. You taught me the difference between bullish and bearish. Bullish means they think the market's going upwards because a bull goes up.
I've got a great explanation for bull and bear. Okay.
Yeah.
A bull's horns go upwards. That is a positive market or upward market. The bear swipes its paw downwards. That is a negative market. These are not terms that we came up with, but that's the industry and how they came about. Absolutely, you're right.
So this Mr. Buyer, because this is where I was stuck for a second. I was like, well, why would he buy this from me? But the reason why Mr. Buyer is buying this from seller Rav is because he is bearish on the market. So it's at 130. He thinks it's going to go down below 120 and then knows that I have the obligation to buy it at 120. I'm happy because I'm buying a great stock at a discount at 120. I don't mind now owning it. He paid me $400 to be able to do that. Now, if this stock doesn't go to 120, if it goes up, if it goes sideways, if it goes to 121, 120 and 1 penny, then I'm not obligated to buy this, and I made the premium of $400, and this is what you're saying happens over and over and over again, and people are seeing 2-3% a month compounding doing this, but you have to really know what you're doing. We're just touching the surface of this. What would you say is the biggest mistake, before we go to break, what is the biggest mistake that somebody encounters, because they really just don't know what they're doing? They'll watch a show like this and they say, okay, I'm going to jump in there. What's the biggest mistake that people make?
I'd say the biggest mistake is picking poor quality stocks that they really don't care to own. But instead of saying, so when we make a trade here at Theta, we always make sure it's a high quality company, because we make it so our worst case scenario is that we own a high quality company at a discount, high quality shares at a discount. The biggest mistake people make is agreeing to buy stocks that they really don't want to own or know much about, but they're getting paid a lot of money for it, right? Because these stocks are volatile. That, I would say, is by far the biggest mistake. It's greed, essentially.
Okay, so this is no longer Apple. It's ABC, and this is no longer $400. It might be $2,000, and they get greedy. They look at the $2,000 premium. They know nothing about this stock. Now this stock falls all the way to like $90. And
you don't even know if it's ever going to come back up again. You don't believe in this company. That's exactly what I mean by. So instead of being satisfied with that $400 return, which is still very healthy, very substantial, getting greedy and say, you know what, I can make 10, 15% this month if I just agree to buy, this cool new cannabis stock or this cool new software company that came out, that hasn't been around, that's not making any money, but I'm getting paid a lot of money for agreeing to buy it. That is by far the biggest pitfall people fall into.
Well, listen, I want to thank you for introducing me to this. along with mutual friends, but you've been in there with me for the last 15, 18 months, teaching me, Omar. For you at home, don't go anywhere. We have more from Omar Khan, learning how to make money selling stock options. We'll be right back. Hey, it's Rav. Welcome back to Everyday Investor. We're talking to my good friend Omar Khan, learning how we can make money selling stock options. Omar, this is just really fascinating stuff. Can seem complicated, but really once you get the hang of it, it's not so much. So we talked about the person who was, I guess the word would be speculating, right? So he sees a stock out there at $130. He thinks the market's going down. So he says, okay, Rav, I'll pay you, Rav, $400.
Or $4 a share.
Or $4 a share times 100 contracts. I'll pay you $400. And if this stock doesn't hit 120, if it goes upwards, if it goes sideways, Rav wins and I get the $400. If it does go to 120 or below, now Rav has to buy it at 120, but I don't mind because you said the secret sauce is never play this game unless I'm willing to buy that stock. I'm happy with that company. And I think, Omar, that's one of the things that you do that most people don't, is you only trade stock options with the top 10 to 15 stocks on the S&P that pay dividends to their shareholders. I think that's what the difference is. But this is speculation. You've also taught me that there's another kind of buyer, and that's the kind of buyer that wants to hedge his investment, hence what you have, the Q Theta fund, a hedge fund. Teach us a little bit about what that means, hedging.
Yeah, so what that means is, let's say, Apple's trading at $130, okay? Now, when we sell a naked put, okay, which means we're agreeing to buy Apple for 120, okay, so it's at 130 right now. We say to ourselves, hey, we're more than happy to buy this for 120, okay? And simply for agreeing to buy Apple for 120, and again, keep in mind, we buy it for 130 anyways, we're far happier to buy it for 120. Just for agreeing to buy it for 120, someone is willing to pay us $4 a share. So you must be wondering, why would they do this? It doesn't make any sense. It seems illogical, right? Well, there's two different reasons like we talked about. One is the hedging, okay? The person who is hedging themselves. That person saying themselves, hey, I have to make sure that even if Apple goes to $110 a share, I got to get $120 a share because I need this money for a down payment on a home, okay? Let's say an investment property. And they take out insurance worth $4 a share for the next 45 days. We are more than happy to take that $4 a share from them because we want to own Apple at 120, and we got a nice discount, and we got paid $4 a share. The second type of person who is paying that $4 is the speculator. Okay, now that person really doesn't, their only job is their only goal is to take that $4 a share, small amount of money, and turn it into a large amount of money. So let's say theoretically, if Apple were to go down from 130 down to 110,
yeah,
right? Well, then that $4 a share would now be worth $10 a share because they could sell it for 120 and it only cost them 110 to buy it. So they made $10 a share, but they paid for it. So the net profit is $6. So what people who are buying these options are looking for is, one is hedging, that example of that homeowner looking for a down payment, and the other type of person is a speculator, right? More gambling mentality. They're looking to turn a small amount of money into a very large amount of money into a short period of time. We are more than happy to take their money because we're happy to own Apple at 120. Now, a lot of people ask, well, why would someone pay this much money when the odds are so heavily stacked against them? And I've been trading options for 22 years. I still don't quite know why, in a sense, like psychologically. But then again, if you drive by a casino, we could drive by a casino, and you think, it's full, and the odds are heavily stacked against everyone there. They know that. Yet that thrill of turning a small amount of money into a large amount of money, that is something that's innate in some human beings. And, and we're more than happy to take their money, again, because we're more than happy to buy Apple. Our worst case scenario is that we buy Apple at $120 in this particular example. We're more than happy to take their $4 a share. So I think that's the two types of people that participate in this market. And we are acting as the de facto insurance provider. We're simply insuring the price of Apple for 120 for a span in this example for 45 days. So for us, it's a win-win because only one of two things can happen for us. Either Apple stays above 120 and we keep the $4 a share, or Apple goes below 120 and we have to buy Apple for whatever price it is, but we keep that $4 a share no matter what happens.
I am so happy. I bought a stock at 100, it's gone to 150. I want to hedge this. And so if it goes back to $100, I'll be sad because I made zero money. If it goes below $100, I'll be really upset. So how about I'm happy that if it goes to $130 and for me, it can go no less than that, I'm happy. And so what Rav is willing to do is he is willing to buy. He is willing to buy, not sell. Rav is willing to buy to Mr. Seller, which is Omar. So Omar is the one that is the seller. And I'm saying to Omar, listen, Omar, I will pay you a premium, I don't know, $400.
Or we'll just call it $4 a share for the sake of
$4 a share, $4 per share, okay? And then times 100. So I am willing to pay you $400 total. I'll pay you that if you promise me, obligated, to buy at 130. So at least I know I have made my $20 per share. I'm happy to do that. I want to keep this because I think it's still going to go up. But just in case, I want to hedge my bet, if you will, that Omar, you buy it at 130. You're the seller. You buy it at 130. What's going on here with my new board? You like all this? This is called technology. I'm still figuring it out. So
I like it.
You buy it at 130. I bought it at 100, so I still make my $20 a share minus my $400 that I gave to you. I'm happy. You're happy because you really like this company. If it was at 150, you don't mind buying it at 130. Is that the gist of what we're talking about here?
Yeah, that's well explained, Rob. That's exactly what it is. Let's say you bought the stock for 100, it went to 150, and you say, you know what? I think it's going to go up, but just in case it doesn't, I want to make sure I can get at least $130 a share because I might need that money for something else, a better opportunity, real estate deal, or whatever it might be.
So this is called hedging. If I was speculative and I was bearish, meaning I think the market's going down, Rav thinks the market is going down, then I may still also use this strategy because I think it's not going to 130. I think it's actually going to go to 120, but Omar has to buy it at 130. So I actually make $10. I'll pick it up at 120, sell it to you at 130. I actually make the $10 per share. That's the guy who's speculative.
Right. So he turned $4 a share into $10 a share. So his return is, 2.5 times his money, right? So for that person, he's like, well, I just made, $6 a share. That's 150% profit. They're happy because they turned that small amount of money into a large amount of money. The reason we're happy as well is because we wanted to own it at 130 or less, and we got paid $4. So really, we're buying it for 126, and we believe it's going to go back to 150 plus one day. So for us, every single trade we do is a win-win scenario for us. Either we own the shares of a high-quality company we like at a discounted price, and we got paid for it, or we don't have to own those shares, and we still got paid a healthy premium for providing that insurance. So for us, every single trade we do is a win-win scenario.
Now, the reason why you, Omar, would never buy stock options, you would never be Rav in this scenario, because if this $150 stock doesn't hit 130, Rav just paid out $400.
Yep.
And what you've taught me is the number one rule when it comes to this is to never lose a dollar. Right? The second rule is to remember rule number one. So you're not interested in buying stock options. Many people are, but you've been doing this for 20 plus years, you and your team. What's you and your team? 100 years combined? What is it?
Yeah, we're well over 100 years of trading experience combined. Yeah.
That's right. And you said, Rav, I would never be a buyer. I just want to be the biggest companies in the world, insurance companies, and I just want to sell insurance to Rav, people like you, if you're buying this. Omar, this has been fantastic. We are going to bring you on multiple times throughout this year, 2021. Time has passed. I love learning this kind of stuff. Again, for you viewers at home, please just learn. Don't start practicing unless you are educated on this kind of stuff. People like Omar have been educating me and a few of my friends, and we've actually been doing quite well with their tutelage. But Omar, just some kind of closing thoughts here. We're not going to definitely cover it all, but what are some closing thoughts for people that have even kind of interest in this kind of stuff?
Yeah, some closing thoughts. I would just say, think of it, it's a difficult concept to grasp at first, but think of it this way. You walk down downtown of any major city here in North America, and you look at this, you look up at the buildings, and they're generally banks, insurance companies, that type of stuff. So the question is, do you want to be the insurance company, or do you want to be the person paying the insurance? Now, I own a lot of real estate, right? I have a sizable real estate portfolio that I've acquired over the years. I know how much I pay in insurance, right? And I know how few claims I've ever made. In fact, I don't think I made any claims. So do I want to be the person paying that insurance, or do I want to be the person collecting that insurance? So we can't do it in any other field. We can't do it, and we can't be insurance companies, but we can be the insurance provider in the stock market. And that is essentially what we do. And, it's quite profitable for us.
All right, buddy. Thank you so much for being on the show with me.
Thanks for having me, Rob. I look forward to being on in 2021 and having a great year with you.
And thank you, viewers at home, for watching. Without you, we wouldn't have a show or listening via a podcast. Make sure you tune in next week, same place, same time. Honey, I love you. I'll be home soon. Ciao, everyone.